Welcome back to Lamb's Cryptoverse. Today we're going to do something different, and you know I love to do different stuff. Today we're going to look at Charlie Billelo's, and that's in purple here, his investing resolutions for life, and compare them to my framework and what I think about things. So I'm publishing a video on my framework for next year. So we're going to intertwine that with this and also with my beliefs, my so-called value system compared to what Charlie Billelo is saying, because I have some big disagreements and some agreements. The first one is that he's saying, as of this writing, and I highlighted here for you, the S&P 500 is down 18% year to date for its worst year since 2008. And earnings are down 11%. First of all, I couldn't find that earnings down 11%. I see no data supporting this. The only data I saw, the worst data I could find, is that earnings are down maybe 3%, and they're not down much for next year. So I'm not seeing that earnings earnings have come down and that they're going to decline for next year. The second thing I'm not believing, I should say, is that S&P is down 18%. I think we could go down 50% from the high. So I don't think this is enough. And he's making it sound like this is really, really bad, and it's the worst since 2008, since the great financial crisis. Well, you know what? We had a bubble like we had in 2000, and we have inflation. So I think things could get much worse. So that's my other disagreement. And here he's shown again that, this is for 2020. He was saying, his point was, look, the market went up a lot, even though S&P earnings were down a lot. But this time's different. We've got high inflation and a Fed that ain't quitting, that keep raising rates and tightening liquidity. So I don't agree with this. The third thing is, that's just my little daughter there. She's making a little mess here. The third thing is, he's saying, and it's his first here, that he's embracing risk, and I disagree with that. That's how you become insolvent, by embracing risk. I think because everything is so risky, especially crypto, you need to use good risk management, and so I disagree with that. And he talks about how you can make so much money in stocks, that this is probably from Ibbotson, basically that you can make 10% annualized return in stocks versus treasuries. Well, first of all, this is 2021, doesn't include 2022. So this 10-year rate is probably lower, more like 5%, 9.6. And I want to make a note, which he didn't talk about, that volatility is high. And so we don't see that here. We don't see volatility numbers. The next point here, that he's talking, and again, he talks about embracing risk, which I disagree completely. Here he's saying, because the consumer price index is messing up, and basically we're losing a lot of purchasing power because of high inflation, that we should be in S&P. I agree, but I think you need to do timing and good risk management. So I disagree with him, with his approach, which is like, it sounds like he's saying, buy the S&P and stay in it, or buy risky stocks and stay in it. He's saying embrace risk and play for the long game. I don't agree with that. Yes, you need to play for the long game, but you need to time the market. But by the very least, you need to do DCA, dollar cost averaging. And then he talks about the coin flip. The odds of a positive return in every given day is barely higher than a coin flip. So basically he's saying, just put all your money in the market and stay in it. So here we have the probabilities based on different holding periods. So the probability of you making money over one day is 53%. I actually think it might be even lower than that, maybe 52%. But over 30 years, it's 100%. He doesn't show you a few things here. Number one, he doesn't show you when you're putting that money into the market. If you put your money into market at the market tops, you wouldn't get these 100% or over 75% probabilities that you would get a positive return. So he's leaving that side of the equation out. And this is why you have to be very careful with statistics. And you know the saying, there's statistics, and then there's lies. Basically, and actually I read it in the reverse order. It's lies, and statistics. Basically saying how statistics could tell you anything they want to tell you, and they could basically lie to you and confuse you, and you can make big mistakes by looking at people's charts. And then what else we've got here? Oh, another one. Diversify. I would say diversify, meaning you got to be careful. I agree you should diversify, but at different time periods, meaning, then he shows some charts here. I think you should buy, gold and S&P and value stocks, and he's showing all the different returns, but you should buy them at different time periods. Again, you should diversify, but you should time it. And he's kind of saying that actually, but he doesn't say it in that way. He doesn't use the word timing. And he's showing you how the growth stocks did better than value stocks, and on and on. We've all seen these charts. Constant beta outperforming alternatives. I think when he's talking about constant beta, he's talking about managed futures. And then alternatives, he's talking about merger arbitrage. And let's get to some other data here. Then he says, in the world of fixed income, we've witnessed the same, with diversification in terms of lower duration and credit proving their worth. So I don't know. I could see what he's saying, but I don't like what he's saying. I don't like the story he's saying. He's showing that it makes sense to buy short-term treasuries. Look, you actually made 1% this year. But again, you need to time these. And if you listen to what I said in my predictions, I said we're going to get an inversion in the yield curve, and probably because longer-term rates are going down. So that means you should invest in the 25-year zeros on the bottom here and the 20-plus year treasuries. But according to him, you're going to lose a whole lot of money. Again, it's about timing. Yes, you don't want to buy long-term treasuries when rates are about to go up. Like in the beginning of 2022, you did not want to buy longer-term treasuries. But maybe now, or as of the middle of or third quarter of 2022, it makes more sense to buy long-term treasuries as the yield curve starts to invert and as a recession comes. And I think we're going to have a hard landing. So then it makes sense to buy long-term treasuries. So it's about timing. Then he talks about focus on what you can control. I guess I kind of agree with this. You can control your habits and your behavior. And he talks about fear and greed. So I agree with this. You need to have a methodology that stops you from doing this fear-greed thing. It stops you from buying stocks at the high and crypto at the high and selling at the low. Okay, I agree with that one thing. And here he gives data. I've never seen this data before. He gives this table that shows you a behavior gap on the right here. And this is a gap that has to do with investing with fear and greed. So I've never seen this before. It kind of makes sense. He's saying that you lose 4% if you're using fear and greed in sector. And I think he means like investing in technology stocks at the high and then selling at the low. That's what he means by fear and greed, or this behavior gap. This is from Morningstar. And I think we covered everything except this last table. So yeah, I'm going to go back up to this table. And in this table here, again, let's see if he's got some notes. He talks about drawdowns. And I think he's like focusing, at least implying that we had a big drawdown in 2022, and it's not going to get much larger. And I disagree with that. I think we can get a 50% drawdown, which would be twice as high as what he's got here for 2022 so far. I don't know. I just think it's too early to be calling a bottom. I think we could have something like we had in 2002, 2001, because this is where we had the bubble. and 2008 because we had that global financial crisis. And then in the 70s, because this is also, the 70s are also an analog to what we had now, he may prove right because we had small drawdowns. It's hard to believe, but we had small drawdowns in 1979, 1980, 1981, and 1982. I'm very surprised, but if you notice, these are long bear markets. And we also had a drawdown in 74 that was bigger than what we had now. And I think that was the oil embargo. So just to conclude, Charlie Billelo saying you should embrace risk for 2022, 2023, and you should diversify because the market probably cannot go much lower. I mean, that's how I'm reading this. I disagree with him. I think you need to, yes, you need to diversify, but you need to use timing. And I think things get a lot lower because I think we're going to have a hard landing. And when you have a hard landing, earnings estimates decline. So yes, we've had a PE compression, price to earnings ratio compression, but we did not have a cut in earnings estimates yet. So I think there's some disagreement with us. So let's see what happens. So just be careful out there, like I like to say. And thank you all for listening to Lamb's Cryptoverse. And don't forget to like us. Bye-bye.